Welcome to another episode of Taking Stock for the week ending the 1st of May 2026. I'm Kien, Trinh, Head of Research at Stock Doctor. And joining me today is our Senior Equities Analyst, Jason Yin. Welcome, Jace. How fast time flies, huh? It's already start of May.
That's right. Almost halfway through this year, Kien, so it's going really quickly.
And it doesn't get any busier with the banking reporting season right here and now. But before we begin, just a reminder that the information we provide today is of a generic nature and doesn't consider your personal situations or needs. But Jace, it's been another muted week on the markets. Markets are becoming increasingly cautious. You've got oil prices, they are rising again, while the US and Iran, they continue to fight it out, imposing blockages on vessels in the Strait of Hormuz. Meanwhile, central banks are tackling the threat of elevated inflation.
Yeah, that's right, Ken. I mean, the inflation print at 4.6% doesn't look alarming at first glance, but when you really break it down, it is becoming pretty broad-based. Fuel has been the initial driver, but we're now seeing those pressures flow into every aspects of the economy, including everyday goods and services, which is by far way more difficult for central banks to control.
Yeah, that's right. And the challenge is for the RBA. They are already dealing with inflation above target before this energy shock. And now they're effectively facing a second wave. And that limits their flexibility, particularly if risks of a recession or stagflation begin to rise.
Exactly. And markets are pricing in another rate hike next week and potentially more later on this year. The bigger issue, Ken, is what does this mean in terms of earnings expectations? I mean, we're already starting to see a shift in terms of tone from companies, which suggests that downgrade cycle probably is beginning or has begun. And there are also a couple of high profile names that have downgraded full year guidance, including Cochlear, Wally Parsons, Qantas, Aurora, and Domino's Pizza.
But let's turn our attention now to some star stock highlights. One that's actually hanging on to their guidance. First of all, that's Star Growth stock IRESS, a financial technology provider for wealth managers. Now, in their trading update last week, they did mention that revenue will come in at the lower end of their range of between 520 to 528 million. Now, that led analysts to soften their expectations by around 2% over the week.
Yeah, so what we're seeing is slower decision making from clients, particularly around new businesses and also non-recurring revenue. Now, these aren't lost contracts from what we're led to believe. They appear to be delays, but the dynamic reflects a more cautious customer base in the current environment.
Yeah, but more importantly here, Jace, is that the level of churn that remains stable and management is still targeting margin expansion, and that's through cost efficiencies, AI investments. So operationally, the business is holding up, but the growth side is taking longer to materialize.
Yeah, and that's really been the story with Iris. Management have done the restructuring and also simplified the business, but the market is wanting a little bit more in terms of consistent top line growth before re-rating the stock becomes justified. Hence, this is why the share price is trading at a bit of a steep discount to fair valuation.
Yeah, definitely there, Jace. But moving along from financials to energy, Woodside Energy, they did deliver a solid quarterly update with guidance maintained. Now, the dividend yield is sitting around 8.7% gross, which looks attractive, Jace, but there may be some nuances here.
Yeah, operationally, it was a pretty strong quarter for Woodside. Higher energy prices obviously helped offset some of the lower production that we have seen due to weather disruption. At the same time, the company is undergoing a pretty heavy investment phase with major projects like Scarborough, Trion, Louisiana, and Beaumont all coming online pretty shortly. And that's been the critical path for long-term growth, but it does come with a few trade-offs over the near term.
Yeah, that's right, Jace. Capital expenditure has increased significantly, and you've got a rise in net debt as a result. But that means free cash flow is being partially absorbed by growth investment. Meanwhile, there is that commodity exposure layer on top, which does add another level of uncertainty, especially to those dividends.
Yeah, nonetheless, the strong earnings revisions have contributed to the uplift in terms of free cash flow, which has been decent in terms of margins above the dividend payment. Members need to remember that free cash flow is operating cash flow left over from investment capex. So for now, the full year dividend appears sustainable.
That looks good, Jace, there. But we've had also some reports from the banks and supermarkets. ANZ today, they bet expectations with bad debts looking like they're under control. But we'll do a full bank review once they have all reported over the next few weeks. So meanwhile, you've got Coles and Woolworths. They are finding inflation. It's impacting their margins. So it's been quite challenging for them. But please refer to our corporate calendar for full details. And for Under the Microscope this week, let's turn to Codan, a diversified technology company operating across communications and metals detection. The company delivered a guidance upgrade this week, about 11% above expectations. Jace, what's been the drivers here?
Well, demand has really accelerated, Kien, particularly from defense customers, with pretty strong momentum in unmanned systems like drones and also remote controlled vehicles and also software defined radios, which can adapt to different networks and frequencies to avoid jamming in certain regions. That being said, a lot of it is driven by structural increases in defense spending.
And importantly, though, Jace, that growth is translating into higher margins as well, with operating margins expected to reach now 30% by the end of this financial year. And that's 12 months earlier than planned.
Yeah, so that's been a pretty strong uplift. At the same time, the metal detection business continues to perform pretty well, supported by elevated gold price and also successful product launches. While that division is more cyclical in our opinion, it does still represent close to 50% of earnings, so it is pretty material.
Yeah, I'm not surprised that gold remains quite elevated in terms of the price, so it's still attracting a lot of customers. But over time, the market is likely to place greater weight on that communication segment, given it's a high quality and also it has more stable earnings profile.
And this brings us to valuation. The stock is trading on a forward P of around 42 times, which is very elevated relative to both its history and also the broader market. But this does reflect confidence in the growth outlook as the market is increasingly viewing Codan as a defense-aligned technology business rather than a traditional industrial one, and therefore justifies a higher premium.
Yeah, that kind of makes sense, Jace, doesn't it? That's why it's also trading close to fair value from those consensus analysts. For investors who are overweight, it may make sense to take some profits after the recent strength, but for long-term investors, though, those structural growth drivers remain intact, particularly in the communication segment, which continues to benefit from global defense trends. Now, given the current geopolitical environment and rising defense spending globally, there has been some interest in stocks, especially in this area, after we've spoken about Codan. So this week, a few investors have been asking, are there any other defense stocks on the ASX worth considering?
Yeah, and this is a pretty timely question, Kien. And the most obvious and practical way to approach this is by using the Stock Doctor filter tool. You can build your own filter by entering keywords like defense, military, or drones under the business description field. From there, you can layer in additional criteria such as financial health, return on equity, margins, market capitalization, 1 year price return, and also earnings revisions to really narrow down that field.
Yeah, these other fields are quite important because they shift the focus away from simply chasing the theme to focusing on those companies that are actually delivering financially. And within that thematic, especially if we use the keyword military, there's a wide range of businesses, but not all of them are at the same stage of maturity.
Exactly, and that's something that you need to be cautious of. So when you do apply these filters, many companies are financially weak or unprofitable, but those that do look financially strong, included within this list, could be Duratec, which is an engineering contractor specializing in asset protection and defense and also resources.
And also on that list, I noticed there's a company called Elsight, ELS is the code, and they provide network connections for drones and autonomous systems. Let's also not forget about Drone Shield, which uses counter drone systems to track and neutralize unmanned aerial threats. But just be mindful here that you need to understand those risks, especially with Drone Shield and the governance issues with this stock.
Yeah, that's a really good point, Ken. A lot of these businesses vary in terms of scale, profitability, and like you said, risks. So further analysis and due diligence is still required before making any investment decisions.
Yeah, good point, Jace. But that brings us to the end of this week's episode. And thanks, Jace, for your insights again. I know how busy it is, and we'll do a full bank reporting season once it completes over 2 weeks.
It's my pleasure as always, Ken. And just to quickly sum up today's video, inflation remains rather elevated. Interest rates are likely to head higher, and we are starting to see early signs of a downgrade cycle.
Yeah, stock selection so important here. And in this type of market, discipline becomes critical. Staying diversified, focusing on those quality businesses, and managing risk will be the key. Until next time, have a happy, healthy, and prosperous week ahead.